Well, hello and welcome to Market and Economic Cycles. This is Robb Reinhold, and I hope you are ready to talk about some really nerdy things. Now, I say that on a lot of my videos, and when I say that, I say that in pure excitement. I know it comes off as sometimes like, oh, we're going to talk about nerdy things, but you need to understand this is the stuff that I love to talk about. Alright, but before we just jump right into this, I want everyone to understand that everything we're going to be talking about in this session here is theoretical. Theoretical. And if you go into the world of investing and trading, there's two schools of thought. There's one called fundamental analysis, which is the study of economics, the study of what should happen in certain things. And then there is the school of thought of technical analysis, the study of what actually is happening, price action. Everything we talk about, except at the very end here, is going to be about theoretical, what we call fundamental analysis. What should happen when we see these things happening in the world, in the market, in the economies. So it's going to be a lot of theory, a lot of what should happen. And at Maverick, we always like to say we like it when theory, when the fundamentals of what should happen match up with the technicals, what is happening. That's always a nice time to get into a trade when they both match up nicely. Alright, so first I want to start off with a quote. Now I do not know who Sidney J. Harris is, but I like this quote. And it basically says, history repeats itself, but in such a cunning disguise that we never detect the resemblance until the damage is done. Alright, and really what he's talking about is that things happen over and over again, but each either generation or each year, we don't recognize that the same thing is happening until we're through it. Once we look back, we say, oh, okay, we see it. But in that moment, it's like, oh my gosh, this has never happened before. This is totally new. And one of the most dangerous words you will ever hear as a trader and investor is the words, this time it's different. Because in the end, it's not different. Now, yes, there's going to be different names. There's going to be different things that are happening. And I remember in 2008, when it seemed like capitalism was collapsing after all the banks were going broke. And I remember thinking, oh my gosh, this has never happened before. And then I cracked open one of my favorite books called Manias, Panics, and Crashes. And I read through the history of economic history that we have since the 1500s that this has happened many, many times. And you know what always happened? It always came back. And I started to realize that, okay, this is just simply our generation's crisis. You could go back to the Great Depression, and that was our grandparents' generation's crisis. You could go back to our parents. Now, again, I'm all assuming that you're my same age, of 43 at this moment. But, you know, maybe like my parents' crisis was the inflation of the late 70s, and then the recession that came in after that. Every single generation has their crisis that they think it's the first one that's happened. But when we take a look back as scholars, we see that they're simply market cycles. And so the purpose of this session is to really talk about these market cycles. Because as a professional trader who does this year in, year out, over and over and over again, you're going to encounter these market cycles all the time. Sometimes it's going to be a bull market. Sometimes it's going to be a bear market. Sometimes it's going to be a sideways market. Sometimes there's going to be low volatility. Sometimes there's going to be high volatility. Sometimes volatility is going to be falling. Sometimes it's rising. Sometimes there's going to be lots of volume. Sometimes there's going to be low volume. If you trade long enough, you will see and be in these situations or in these market conditions all the time. And so being able to recognize where you are in the market cycle is actually very important. One of the things we talk about at Maverick is that typically summer, especially the month of August, is usually a low volume, low volatility period. Now, that doesn't mean that happens every August, but we go into every August telling our traders, just expect there to be lower volume, lower volatility. Because of that, we take less trades. Because of that, we probably trade more news events. And then at the first of the year, January 1st, we usually start to see a pickup in volume. Again, it doesn't happen all the time, but it usually does happen. And so we like to make a lot of trades in high volume, high volatility situations. And so understand that when you trade as a professional trader, you will be trading in different market environments all the time. And sometimes your strategies won't work as good in one as they do in another. Recognizing where you are in the cycles is a huge thing. So in this session, we're really going to talk about direction, volume, and volatility. These are the things that change with market and economic cycles. Right, so the first thing I want to talk about is economic cycles. Now we're going to basically take a step back and look at the big picture. And then we're going to get closer and closer and closer into it to where we can really boil down into some specifics. But for any of you that did a college class or even a high school class, they've broken down economic expansion into 4 different areas. They have the recovery phase, the early upswing phase, or what is typically called the growth phase, and then they have the late upswing phase, which I've also heard referred to as the mature phase, and then we have recession. So this is the economic cycle. After recession, the economy recovers, starts to grow, becomes mature, and then it leads to another recession. So we all understand this as far as economic theory. This is just economic theory. And we can even go back and see that, okay, this has happened all the time. So if you take a look back to 1945, let's see, what's there been? 12 points of time where there's been economic expansions, times when the market went up. Okay, we all get that. But here's the thing is that every time we look at the current situation, a lot of times people say, oh my gosh, this time it's different. This time is different. Right now we're in an upswing. From June 2009, we're in a bull market. Now it's funny because everyone is now talking about, oh my gosh, they ask me, like, when they find out what I do for a living, oh my gosh, do you think we're going to go in recession? My answer is always, of course we will. And then they go, oh, are you serious? You think we're going into recession? I say, well, I don't think we're going into recession right now, but I can guarantee you there's going to be a recession in the future. And then they kind of say, oh, of course, but do you think there's one coming up? And again, then we have a real discussion. But this is just how the market runs. It runs up and down. So we've had 12 expansions, and we've had 12 recessions. So from the 1950s, we've had 12 recessions. We've had periods of time. Now again, let's talk about what a recession is. A recession is where GDP growth is negative for 2 consecutive quarters. It usually has employment losses. And you typically see a bear market in the stock market, which is a greater than 20% decline in the stock market. So these are going to happen. Sometimes these recessions are short and only last a couple months. Sometimes they are long and last for years. Sometimes they're shallow, sometimes they're deep. But the whole point is you need to understand that anytime you get into a trade, you are going to be somewhere in this cycle. You're going to be somewhere along this cycle. Now, where you are in the cycle, now that is the $24,000 question. You know, are we here in the cycle? Are we here? Are we in recession? There's lots of things we talk about every single week with our traders about where we are kind of in this cycle. The stock market is a great way to measure this cycle. When the stock market is in an uptrend, guess what? The economic activity is also in an uptrend almost all the time. Now the stock market does lead the economy. So the stock market usually peaks out about 6 to 9 months before the economy starts to go into recession. And when the economy goes into recession, the stock market goes down. And you know what it does? It bottoms out before the economy actually turns. So that's why we are always looking at the S&P 500, we're looking at the stock market, we're not looking at it because we want to make any stock trades, but we're looking at it to understand where we are in this cycle. If the stock market is going up, then we know that we are somewhere in this cycle. Where? Again, that's where they have all the people on TV debating it, and these people are Harvard graduates, very smart. In the end, you can always see where the top was, and you can always see where the bottom is, but when you're in it, you can't see where it is. But just to understand, we're in this area, somewhere in this area where the economy and stock market are going higher. It gives us a real clue in the currency market as far as what we should be looking for. And in the currency market, we always talk about risk on, risk off. And we talk about this a lot. We talk about this every single trading room. We talk about sometimes we're in a period of time where the markets are going higher. Now, when we talk about it in the trading room, we're boiling it down to a much shorter time frame. You know, the trading room is, we're meeting on Sunday saying, okay, what do we think is going to happen this week? Are we in a risk on or risk off scenario likely for this week? So if you have a risk on scenario, risk on where the markets are likely to head up, the economy is heading up, well then a rule of thumb, and again, these are just a rule of thumb because remember, this is theory. In theory, these are the currencies that in the past have usually outperformed. The growth currencies, or what we call the risk currencies. Taking a look at the 8 major ones, we can separate out the Aussie, the CAD, and the Kiwi. These are typically the best performers when we have a risk-on market. When we have a risk-off market, where again the stock market loses value. And again in recessions, where the economy is losing value, the best performing stocks are typically the dollar, yen, and the Swiss franc. And right now the yen is considered the safest. That's just how it's been over the last about 10 years. Of course, this can change. This can change. However, these are very long-term changes that happen. So in the downtrend, you can see that we would expect that these 3 currencies would be the best performers. Again, as I said earlier, this is economic theory. It doesn't always happen. But let me show you a quick chart of the Aussie-Yen cross. Now this is a chart all the way back to 2005. Now if you remember, during 2005 to 2007, we had a bull market. So during that period of time, you would expect that the growth currencies, the Aussie, the CAD, and the Kiwi would do best, while the risky or the safe currencies would underperform. So you can see the move here was about, let's just call it 80 cents, all the way up to 107. So during that period of time, the Aussie dollar appreciated about 33%, somewhere around there. That's a big, big move for currencies. That's a really big move, and that happened over the space of about 2 years. When we got a down market, a bear market with economic contraction, we saw a move from 107 down to 57. That is an enormous move. That is about a 50% loss. We saw 50% loss in the value of the Aussie against the yen. And this happened in a period of about, let's call it 18 months. Then we have been in a recovery since, and you can see for the most part, the Aussie went up against the yen until right about here. This is where economic theory kind of broke down, because in economic theory it says that in periods of expansion, the Aussie should go up against the yen. And it did from January 09 all the way to January 2015. So for 6 years, we saw generally rising prices in the Aussie against the yen. Something here is broken down, something has happened, and this is where we take a look. We're going to talk about this, how when price action doesn't confirm the fundamentals, we have to listen to price action. But I just want to show you how big of a connection there is between economic cycles and currencies. And this is why we always are looking at the S&P 500 chart to basically say, okay, where is this going? And so really to take a look back at it, let me go back a couple slides. We need to take a look at where the economic activity is, what the stock market is doing, because it's going to give us a great idea of the direction of which way currencies are going. And again, in your career, I promise you, there's going to be times where it's risk on, where it's risk off, where it's neutral. There's going to be plenty of periods of time where the direction is changing. And as currency traders, that's what we're trying to capitalize on, is when these things change, when they're in a strong trend, when they're about to change and go into a different trend. That's what we're trying to analyze all the time. So the reason why we want to learn about these market and economic cycles is to understand that what's happening in the economy and in the stock markets is greatly going to affect what's happening in the currencies. Next, let's take a look at the next cycle of volume. Okay, now volume, it basically tells us how much activity there is. And let me go back to prior videos you've watched or sessions you've been to. And the biggest thing I see new traders fail at when it comes to currency trading is they don't know when to trade. Now it's funny because everyone reads tons of books on charts, everyone learns about setups and breakouts and indicators and this. But they don't understand that the currency market is open 24 hours a day, 5.5 days a week. It doesn't mean there's a good trade every single minute of every single day. A good trade is a high percentage trade where you can make a whole lot more than you can lose. That only happens a few times a week. Now, if there's a lot of activity in the market, it might happen more. It might happen 10 times a week. If there's low volume, it might only happen 1 time a week. And this is where you as a trader have to adjust a little bit of your trading style based on the volume of the markets. And as I mentioned earlier, going into every August, we talk a lot about this and say, hey, look, typically speaking, Forex volumes are down in August. There's less people trading. If there's less people trading, it means that there should be less movement. Now, the real problem is volume is tough to measure in currency markets. Let me go through exactly what volume is and how it's measured in like the stock market. Okay, every single stock is traded on an exchange. Let's take something like IBM. IBM is only traded on the New York Stock Exchange. It's not on the NASDAQ. It doesn't trade on the FTSE, the UK exchange. It doesn't trade on the French exchange. It doesn't trade over in China. IBM trades at the New York Stock Exchange. So every single person that wants to buy or sell IBM has to go to that exchange. Now that exchange, they publish the amount of shares that were bought or sold during that day. If you want to take a look at options, options are traded on the Chicago Board of Options Exchange in Chicago. This is where we had our last summit. We actually were down on the floor of the Chicago Board of Options Exchange to see the volume going through there. Every single option is traded there, so the exchange publishes how much volume was traded. And then you can know, okay, well, since it can't trade anywhere else, I know that's the volume. Futures. Futures trade on the Chicago Mercantile Exchange. They publish, again, everyone has to go to that exchange to buy or sell that product. The problem is with Forex, there's no central exchange. Forex volume is simply a lot of banks making trades. There's no central exchange. No one is publishing overall volume because no one even knows what overall volume is. So the problem is if you pull up a chart of the Aussie yen currency pair on Interactive Brokers or on anywhere and you ask it to show the volume, volume is going to be blank. Volume is going to be blank. It's not going to help you out. So I wanted to go over just a couple ways to get volume if you want on currencies. Now I'm going to use my first one, and this is the one that I use because I'm not a super detail oriented trader, because I find out the more things that I require myself to look at, the more times I miss what I consider to be good trades. So one of the things I like to do, and this is completely subjective, but I like to use this right now. Now the frequency of the bid, ask, and price changes. When there is volume in the market, you can see it on your screen. You can see that things are moving. The bid ask is changing very rapidly. There's lots of trades going through. The sizes on the bid ask are changing very rapidly. And I can just look at quotes and I can tell if there's a lot of activity or not based on how much the bid and ask is changing and how much sizes are changing. Now, if you are new to Forex, I'm going to give you 2 times I want you to watch the bid ask and the price changes. I want you to watch the bid ask and price changes in the morning in the US session. Let's call it 9 a.m. Eastern time. So 9 a.m. Eastern time is when the banks open. So I want you to watch how fast the bid and ask change at 9 a.m. Eastern time. And then I want you to watch the same pairs at the start of the Asian session, which is 5:15 p.m. Eastern time. If you look at the bid and ask right now, it's hardly moving. It's hardly moving. Nothing's moving. The screen, there's no flashing. There's just not much activity. Compare that to the open of the US session, you're going to see the difference. You're going to see that you can literally look at that quote board and you can see things are changing and moving very rapidly. That's how you can tell that the market's hot. That's how you can tell that there's volume right now in the markets. One of the sessions we have all of our traders watch is what's called the Forex time chart and market movements. And we talk about periods of time that you know you're going to get more volume. We talk about the US Open and we talk about the England Open or the UK Open. Those are the times that every single day we see more volume than other periods of time. We also talk about around major news announcements, you see lots of volume. In times when the market is showing lots of stress, you see a lot of, and a lot of volatility, you see a lot of volume. But let me just point you to some other things that you can also look at. Again, if you're fairly inexperienced and you say, you know what, I don't have confidence that I can really read that, there are a couple products that you can use to actually get volume. Alright, so we can use the CME Forex futures. So I'm going to push everyone off. If you don't know what the currency futures are, there is a video in Advanced Concepts Extra Sessions titled Currency Futures. It talks about what they are and how they work. They're traded on the CME so you can see volume. You can also look at the volume of the Forex exchange traded funds. I'm going to talk about those in a little bit. And there are companies that have made indicators. Now again, this FXCM volume indicator. So if you think about it, there's no central exchange. But a company like FXCM, which is a currency broker, they can tell you how many trades are going through them. And that's what they've done. They said, hey, we're going to start to publish volume going through us. Interactive Brokers does not publish that information. But if you want, you can go ahead, just type in, FXCM volume indicator. You can get more information of how to read it. But I'm going to go through using the CME FX futures. So you basically just need to put a quote into a chart. So this here I put in the Euro futures. So this is the Euro dollar futures. This is basically the Euro US dollar cross, but it's not spot currencies or spot Forex like we trade. It's the currency future and it's traded on the CME, and you can see volume. you can see during periods of time there is heavy volume. And you can see that pretty much every day here at 9, again this is over a 1 week, period, you can see that there's certain times of the day right at that 9 o'clock level where you see higher volume. And then you can see that there's low volume during periods of time. You can use this to take a look at, okay, I'm interested in trading the euro. When do we usually see the largest amount of volume in the euro? The answer is 9 a.m. 9 a.m. is where we see the largest movement typically. And then again, you need to adjust that for your time zone to see where that is. So by using the currency futures is probably the easiest way to actually get a measure of volume. So again, if you want to see the pound, put in the pound futures, get a chart, you'll be able to see the volume on those. All right, let's next move on to volatility. So again, let me kind of wrap up volume in a little bow here. In the market cycles, there's going to be times where direction is moving. Sometimes it's moving up, sometimes it's moving down, sometimes it's moving sideways. A lot of that is going to be driven by the risk on, risk off of economics and of stock markets. During your career, you're going to see times of high volume and low volume. And there's several ways to where you can see where we currently are on volume. You can take a look and see, okay, what's the average volume? And then I can compare that of when is it greater than average volume. So I'm going to be able to tell by using something like the currency futures to tell where volume is. Once you trade long enough, you start to get a good sense of when volume is picking up and when it's not. It's something, again, I can't quantify it. I try to quantify it by talking about looking at the screen, seeing when the bid-ask is changing quickly compared to when it's slow. But if you aren't there yet, then the currency futures are a great thing to use to tell about volume, overall volume. Let's move on next to volatility. One of the things that's also going to be changing based on the economic cycles is volatility. All right, now I'm going to give kind of a big picture discussion of volatility, and then we're going to drill down into individual volatility and how to read it. But just think about volatility. Volatility is how big things are moving. Now, if I ask you a question, and let me ask you this question. Where do you think volatility is higher? In a bull market or a bear market? Now, volatility is basically how fast and how much things are moving. Hopefully everyone answered a bear market. Volatility is, again, I'm going to use the term always. Of course, there's probably one time in the past where it hasn't happened, but I'll still go ahead and use the term always. Volume is always higher when the market is crashing than when it's rising. Now, yes, there can be some very fast rises that are surprising that do come with a spike in volatility, but for the most part, volatility is when there's a lot of stress on the market and there's a lot of people unsure of what's going to happen. So during your trading career, there's going to be times where volatility is crazy. The two that I can think of that have happened recently are the Brexit vote. During the Brexit vote, we saw crazy volatility. We saw the pound drop 2,000 pips in a day. That is huge volatility. That doesn't happen more than once every 10 years. I mean, that's just crazy volatility. The other thing I can think of is the unexpected victory of Donald Trump as the U.S. president. That was unexpected. That caused really big volatility. So during your trading career, there's going to be periods of insane volatility. And then there's going to be periods of normal volatility. And then there's going to be periods of slow or low volatility. Knowing where we are in that volatility is really going to help you know when to make trades. So of course, as traders, at least as far as I go, I love high volatility. I trade more when the volatility is high. I trade less when the volatility is low, because that tells me there's not as much price movement. And that's what I'm trying to capture, is price movement. So the big question is, how do we see volatility in the equity or in the currency markets? Well, we're going to go over a couple things. We talk about ATR. We're going to talk about ATR when you get into charting. ATR stands for the average true range. It's basically a reading of how much that currency moves on average over the past, and again, you tell it how many days or candles you want it to read. So if the ATR is rising, it tells you that the volatility is getting greater. If the ATR is falling, it's going to tell you it's getting less. So the slope of the ATR, and we're going to take a look at ATR here in just a second, it's going to tell you a whole lot about where volatility is currently in your pair. Now, if you take a look back in history, and again, longer term charts show it best. If you go back and look at a daily chart over the last 6 months, or even over the last year, you're going to see where it was the most volatile. The point where the ATR is the highest, that's when it was the most volatile. And you can kind of measure where are we today in comparison to where the most volatile period's been over the last year. You could take a look back over 2 years, 3 years, 10 years. You can go back as far as you want and compare and see, okay, today's volatility is here, but over the past, it's been all the way up here and all the way down here. Maybe we're in the middle of volatility. We're going to use and take a look at ATR here in just a second. We can also use the CME futures options as well. I do not want to get too far into this because I think this is a very complicated tool to use, and there's an easier tool I'm going to show you after that. But options have what's called implied volatility. Implied volatility is basically the market's expectations for how much it's going to move. And what you do is you measure this against historical volatility, how much it's moved in the past. So when implied volatility is much higher than historical volatility, then you know that people are expecting a bigger than normal movement. And when implied volatility is lower than historical volatility, you know that the market is not expecting a whole lot of volatility. This is a pretty complex thing to use. I'm going to show you a better tool to use it. But let's take a look first at ATR. And then after ATR, we're going to take a look at using the stock FX exchange traded funds. All right, let's get into ATR here. All right, so this is just, I've chosen EuroCAD and I've chosen it over a 1 month period. So I'm looking at EuroCAD, I'm looking at over a 1 month period using 4-hour candles. So basically I get 6 candles a day. And down here I've put in ATR, and I've used a time frame of 50. And basically it tells me through the last month, you can see that ATR peaked up here. June 15th and 16th was the highest ATR on record, which means that over the past 50 periods, that this last 50 periods had the greatest volatility over the last month. And we can see, sure enough, we did see the biggest move over the past month was in that period. We can see that the lowest volatility for that period was basically June 7th. You can see, again, it takes 50 periods and it measures it and it says, okay, this was the lowest volatility during that 50 period. When the ATR is going down, it tells you that volatility is getting less. When the ATR is rising, it means that volatility is going up. Obviously, we really like to be in trades when volatility is rising because that tells us that the currency pair is going to move more than it usually does or more than it has in the past. Now, that doesn't mean it's going to move in our favor. Again, if you're long, obviously that was the wrong direction, but remember, if we're wrong, we're going to have our stop. We might lose 30 pips when we're wrong. If we're on the right side, we're going to use our trailing stops and we might make 100 pips. That's what we want. Our losers are 30 pips, our gains are 100 pips. Buying into rising volatility or selling into rising volatility is usually very good. And again, this is how the ATR works. Again, I'm not going to go too much into ATR. We have a whole session on the ATR, how it works, how to use it, and we discuss it here. But This is a really great way to tell, are we getting more volatility or less in the market? And you can use any time frame. You can shrink this down to a daily or to a 1-day chart. You can move this out to a 6-month chart. You could use this ATR to really see where we are as far as historical volatility. If we were taking a look at it right now and saying, okay, over the past month, we're pretty much in the middle of the range. So there's not high volatility, there's not low volatility, but we can definitely say that volatility is decreasing, meaning we are likely in a basing pattern. Again, where volatility is decreasing, there's not a whole lot of price movement. You can see that when volatility was decreasing, there's not a real big opportunity for making a lot of money. We want to be trading when volatility is rising. And these are the periods of time where we can actually make some decent money in trading. So again, volatility is either going to be growing or contracting, and over your career you're going to see a whole lot of both. Knowing where you are in the cycle is very important. ATR is probably the easiest and best way to see where volatility is going. Alright, the next thing I want to show you about volatility is the stock FX exchange traded funds. For those of you that don't know what these are, they have created ETFs, exchange traded funds, to mirror some other asset. One of the most popular ones is what's called the spiders. The ticker symbol is SPY, and the SPY will do exactly what the S&P 500 does. Now the reason they created these is that the S&P 500 is an index. You cannot buy an index. So if you wanted to buy all the stocks in the S&P 500, well, before the spiders were made, you would literally have to go buy all 500 stocks at the right ratios. They have created a stock that if you wanted to buy this stock, if the S&P goes up 1%, guess what happens? The spiders goes up 1%. It's a tracking stock. ETFs are now 40% of all stock trading volume. They become very, very big. And they have created ETFs that mirror currency crosses. They've mirrored currency crosses. And I'm not going to spend a whole lot of time going into it, but they always start with FX, and there's some stuff like FXE. That's the euro-dollar cross. FXB, that is the pound-dollar cross. FXA, that's the Australian dollar cross. So we can use these ETFs as a way to see where volatility is in the options markets. Right now, I'm going to, again, I don't have time to go into real great depth here, because if I did, this would be a 4-hour-long class. We have other sessions that cover a lot of these topics. This is just how to read volatility, but if you really want to learn more, there is a session called FX Volatility. And, oh boy, I'm trying to remember where it is. You know what? There's a glossary that you can look it up. So sorry, I can't remember where it is. I want to say it's possibly in the FX 101 sessions, but it's called FX Volatility. And basically, if you take a look at what's called the at-the-money options, so this is the FXB. These are the options on the FXB. Now again, the FXB is the same thing as pound dollar. That's the exact same thing, but they've created this ETF where if the pound dollar cross goes up 1%, the FXB goes up 1%. If this goes down 3%, the FXB goes down 3%. It's a tracking stock. So by looking at the options on these ETFs, it gives us a good idea. So these are the July 21st options. And if you take a look at the at-the-money, what's called straddle, and again, if you don't understand this, I'm going to push you off to that other video that goes into great depth. You can see that the calls are trading for $1.98. The puts are trading for $1.10. That's basically a total of $3. Okay, so if you add the call and put premiums together, this is the expected move up and down of the FXB until July 21st. So it's basically saying the high will likely be around 126 and the low will be 120 during that period. That's what the options market is pricing in, that this is going to be the volatility. So again, we can use this to determine, okay, how big is it? Obviously, this is a $3 move. If we go back in 2 weeks and it is only a $2 move, we know that volatility has shrunk. We know that volatility has decreased. If this grows to 4, we know the volatility has increased. And I'm going to push you off to that session that goes more greatly into depth of this. I would say for a beginner, definitely use the ATR for someone that's pretty experienced, especially with options. This is a great place. It tells you this is the expected range of the pound dollar using the options. Now again, you could use the options in the currency futures markets. I know that's getting even more complex, but I like using these options better because there's much more volume on the options for the ETFs than there are on the options on the currency futures. All right. So let's kind of wrap this all up here. We went through a lot of economic theory. We talked about, okay, when the equity markets are going down, when the stock market is going down, we would theorize that we should see the yen, the dollar, and the Swiss franc perform best because those are the ones that usually do best in the market. And again, we would also be able to theorize that volatility and volume would be increasing. Because again, in recessions and bear markets, in hard down movements, volatility goes up and volume goes up. So we know right there that we know the currency crosses we should be looking at. We know that volatility should be increasing, and we know that volume should be increasing as well. That's a great environment to make a trade. That is a great environment. We know we're going to be getting some large moves, which is what we're after. However, it doesn't always happen, and this is where I started this whole session, is that we talked about economic theory. When we're talking about theory, what should happen. Sometimes, and a lot of times, what should happen doesn't happen in the markets. And so the biggest problem I've seen from traders who learn a lot and use a lot of fundamental analysis is they always say this should be happening. Okay, the New Zealand Central Bank, they said they're going to raise interest rates. So the Kiwi should be going up in value. Okay, I'll agree with that. But guess what? What if the Kiwi is going down in value? Now the problem that people make is they say, well, that's wrong. That's wrong. The Kiwi should be going up in value right now. Right now it's going down, but it's just because the market is wrong. All right. Let's learn a good lesson here. Price action is always right. Price action is the most important thing to a trader. Remember, traders is we're trading what is. We are trading because we want to make money. We just want to be on the right side of the trade. If the Kiwi should be going up but is going down, the correct trade is to be short the Kiwi. But wait, it should be going up. All the economic theory says it's going up. Well, guess what? It's going down. You should be short. Price action is always the most important thing. Now I'm going to leave you with my favorite quote, and this comes from one of our long-term traders. And I remember this was all the way back in 2001. I had been trading for about 5 years at the time, and Joe had been trading for about a year, maybe about a year and a half. And Joe and I were arguing about a trade. And I was saying that okay, this stock should be going up. It should be going up because of this and this and this and this, and I know I'm right. And this is what Joe said to me. He said, I don't care about being right. I just want to make money. And when he said that, I said to him, well, no, you have to be right in order to make money. And he said, no, I don't. And I had always put together that my opinion had to be on the right side of a trade in order to make money. And I actually really thought about what he said, because when he said it, I I remember feeling inside that I had just heard something of just great importance, even though I didn't understand it at the time, and I really thought about it. And I realized that my opinion was really getting in the way of my trading. What I thought was going to happen, was keeping me from trading what was actually happening. And I love this quote, and I love to share it. It's been one of our Maverick trading quotes for years and years, is I'd rather make money than be right. A lot of us get stuck in wanting to be right. And it seems like the more research you do about a trade, the more research you read about, the more you study, the more you do this, the more invested you become about being right. And it stops becoming about making money, and it starts becoming more about being right. Let me go back to this. Price action is the most important thing. Price action is the truth. It's what's happening. Remember, as a trader, our job is to make money. The only way you can make money is if you are on the right side of the trade. Whatever side that is, you don't care. You shouldn't care. Whether it's Kiwi long, Kiwi short, you shouldn't care. You just want to be on the right side. And the current price action is the best way to see which one the right side is. Now again, yes, price action changes. But when we get into the charting, we talk about how the price action, the trends, are the greatest thing that you can use to get odds in your favor. Trends work. And again, I'm not just saying that out of personal experience. Pull up study after study after study. People have gone to great lengths to study trends. The greatest predictive factor of where this currency is going to go in the future is where it's been in the past. If there's been more buyers than sellers over the past 3 days, chances are, and again, it's not just chances are, statistics say the prices are going to be higher in 2 more days. Now again, sometimes they fail. And when they fail, we'll take our losses. But we know if we stick with this rule, that we're going to win more than we lose. So always remember, price action is the most important thing. All right, so let's wrap this up. There's cycles. There's always going to be cycles. Markets go up, markets go down, markets go sideways. Volatility goes up, it goes down, it goes sideways. Volume goes up and down and sideways. Identifying where you are is the hardest part. Now, it's actually, okay, let me rephrase that. Identifying where you are is not all that hard. Okay, wow, I've got rising ATR, I've got rising volume on the ETF, and I've got a lower price. That's not that hard. What's really hard is forecasting changes in that. And this is where people always go wrong. They try to pick tops and bottoms. Do not use this to try to pick tops and bottoms. Try to use this to understand where you are in the cycle. Okay, falling volatility, falling volume, sideways price action. I don't want to make a trade. I don't want to make a trade. I don't want to make a trade until things change. When will they change? I don't know. I'll watch. High volume, high volatility, rising prices. You know what? I'm ready to make a trade. These are the right environments. Then again, it's all about getting into the right chart at the right time. Looking back is much easier to see the tops and bottoms. Don't try to pick tops and bottoms. Just use this to understand where you are in the cycle. All right, thanks for joining, everyone. Everyone take care.